Assalamu alaikum. Welcome to lecture 18 of tax. So in my previous lecture, lecture 17, we went through total taxable profit, TTP. In this one, we are going to go to the chargeable gains for companies. Now, chargeable gains for personal taxpayers we have covered, that is for sole trade and partnership. Now, chargeable gain for companies. So when we go through this, you will see some similarities, some of the things that we have covered before, and some new things. So, starting with gains, the pro forma, indexation allowance, you will be introduced to indexation allowance for companies, then the capital losses for companies, then how tax is calculated when the shares are disposed by companies. What is the share identification rule? The share identification rule, the three steps that we have done for the personal taxpayers. Now we are going to go for the corporate taxpayers with one difference. Then operation of the indexed pool. Computation of the pro forma for corporate taxpayers when we are disposing shares. Bonus and right issues. So bonus issue, right issue, reorganization of share capital. Rolled over relief we have done for personal taxpayers, now for companies. What are the conditions for relief? Operation of relief, claim, depreciating asset, and finally we are going to conclude the syllabus summarize the entire lecture and what technical articles you have to read for this lecture. So chargeable gain, we will be focusing on capital loss, tax when we dispose shares, the rolled over relief, bonus and right issue when we dispose shares, and the reorganization of share capital. Chargeable gains for companies. Many of the rules that applies to individual also applies to company, but there are important differences. See, when we have to study, one might be asking me, ma'am, how do I study twice? Because what I've studied for individual, if I study for companies, isn't it a waste of time because I'm studying the same thing twice? So I would say learn chargeable gain under personal taxpayers first. Okay, when you go to companies, just learn the difference with the individual taxpayers. So in that case, it will be easier for you. Okay, you don't have to unlearn anything or relearn, or you have to learn the whole thing again. No, that thing will not come. Okay, so just focus on the differences with the company, because already you know for the individual, as most of it are same except few differences are few, similarities are more, so focus on the differences. Now, the pro forma. If you see, the pro forma of calculating chargeable gain is similar to that of the personal taxpayer, except one difference is there. What is the differences? For company, there is an indexation allowance. This we'll cover in next section. And also there are some few other differences that are listed below. So this is how we calculate gain. Proceed, we deduct the cost. Net proceed, deduct allowable expenditure. For allowable expenditure, we take acquisition cost with the incidental cost of purchase. Enhancement expenditure is also taken. Expenditure to establish, preserve, or defend the title of the asset is also taken as allowable. Now, unindexed gain. See, at this stage, if it was a personal taxpayer, at this stage we reach to chargeable gain. But here just one more thing we need to add if it's for company, that is from unindexed to indexed gain. How do we convert? Deduct indexation allowance from unindexed. This will cover in section 3 of this lecture. And then we get chargeable gain or indexed gain. It's the same. Okay, this one line is added. Rest everything is same. Okay, now note for SBS. If SBS has been claimed on a building, your SBA will be brought into a chargeable gain calculation by increasing the proceed by the SBS claimed. Okay, this we have covered in lecture 7 when we were doing capital allowances. Now, other differences are here when you are dealing with the disposal of assets. How the capital losses are treated. This will be covered in lecture 19, not in this lecture. Why? Because lecture 19 focuses on all the loss relief, all the types of losses, whether it's property loss, capital loss, trading loss, will be covered in lecture 19. So treatment of capital losses are different for personal and companies. Then treatment of shares and securities are different when it's company versus individual. This was covered in lecture 14. Then availability of reliefs, lecture 15 I've covered. Annual exempt amount. This is not there for companies, not available for companies. So chargeable gain included in the TTP for the companies subject to corporation tax. Here the difference is it is not the capital gain tax. Here it will be chargeable to corporation tax. You will add it with the profit. This we have done in lecture 16. Now, do not confuse the treatment of individuals and companies. In tax, it is very, what do I say, very risky area. Students often make mistakes in this area only. They confuse with the treatment of individual and companies. Please understand. Individual of treatment versus individual of companies. They are not the same. Now we are moving to indexation allowance. This was applied since 6 April to 1982. Why? This is giving relief for your effect of inflation on your chargeable gain. Okay. And this only applies to assets purchased before December 2017. Okay. After this, what happens? After that, your indexation allowance is frozen at December 2017. So you cannot claim beyond December 2017 for indexation allowance. Now, exam advice. Indexation factor will be given to you in the exam. Now, so what do? Indexation allowance is nothing but your cost into your indexation factor. Okay. Indexation factor is movement in your RPI, retail price index, between the month of expenditure and disposal. Now, each item of expenditure will be separately, you have to multiply with the indexation allowance. And it will be given to in the exam. For each cost, different indexation allowance will be provided to you. Okay. Your enhancement expenditure will have different indexation allowance. Your purchase cost will have different indexation allowance. Okay. So you have to take care of that. Now, what about unindexed loss? If you are having a loss before indexation allowance cannot be given if you are incurring a loss. Nor you can turn your unindexed gain into a loss by having indexation allowance. So where indexation would turn a gain into a loss, you can simply reduce the gain to nil. It cannot become negative. You understand? Now, activity 1. So let us understand activity 1, calculate the chargeable gain. It's very simple. Sale proceed is 71,200 before the selling cost. So you need to deduct the selling cost from sale proceed. Then this were the days you have purchased it for 10,000. Additional expenditure is 3,000 in June 2001 and 2,000 in May 2009. Different dates. So if you see the first one, May 1997, this indexation allowance has been given to you. You simply need to multiply this factor with the cost. So here you will multiply it with the 10,000 because you have bought it. Then the first capital expenditure you incurred was June 2001 for 3,000. This you will multiply. And then here you will multiply it with 2,000. You see, that's what has been done here. This is unindexed gain. So we multiply the indexation with the cost and deduct it. Okay, this is your indexation allowance. We deduct. Remember, we deduct the sell cost from sell proceed. And this for your original cost that you have deducted and came to here. After this, you have deducted indexation allowance, all this. And you have reached up to here, which is your chargeable gain. Now, moving on to capital losses for companies. When there are capital losses, you can set off against the current and the future chargeable gain. Current first and then future chargeable gain. You cannot ignore the current and then go to future. Let's assume you are having a gain currently. So the capital loss you have to set off against current gain only. You can't immediately go to future. Okay. They can never be carried back, but you cannot carry back your capital loss to earlier periods. Nor you can set off your capital loss against income. Any unused capital loss will be carried forward against the first available gains. Capital loss against gain only you can utilize. This relief is automatic. You don't have to make any claim. And no partial claims are not allowed. 3. Calculating tax. So a company pays corporation tax on the taxable amount of gains. Okay. How? It will be included as a part of TTP. This TTP was covered in my previous lecture, by the way. The detail you can watch in my previous lecture 17. So that means your gains automatically will be taxed at the same corporation rate. Okay. Now, so the taxable amount. Current year chargeable gain. Deduct the current period capital loss, brought forward capital loss if you are having, and the taxable amount. Any unrelieved capital losses arises if the chargeable gain of the previous accounting period are exceeded by the capital loss. Now, activity 2. Okay, so here fact as in activity 1, but he has a capital loss in the same year 10,000 and unrelieved 5,000, and the company has trading profit 2 million. What should you do? First, solve the gain. You are supposed to calculate corporation tax liability. First, before you touch the 2 million trading profit, first finish the gain. How? What is the current year gain? This is from activity 1. Just deduct the current year loss. After this, you still have brought forward loss. No annual exempt amount. This is your taxable amount. This 30,681 you add with your trading profit. This is your total TTP. On this, you apply 25% corporation tax. Okay. It is more than your lower limit 50,000. Hence, main rate 25%. Now, next, the fourth part of this lecture is shares. Shares we have finished when we were doing CGD, right? When we dispose share, it's a gain. We incur capital gain tax we have to pay for individual, but for corporation, it's different. So this is how it is identified and this order. Remember, for individual, same date as, so the disposal, you have to see whether you acquired anything on the same day as the date of the disposal. So first, same day. This is same with personal taxpayers also. Individual when you are calculating CGD. Second, the difference comes in the second point. You have to see whether you have acquired anything in the previous 9 days on a FIFO basis. But when you were going through the individual taxpayers, it was in the next 30 days from the date of disposal, whether you have acquired anything or not. You match your sale with the purchase. But here it is previous 9 days. But it remains FIFO basis only. And the third one is same. But the only thing is this time it is indexed pool of shares. So it is, if there is more than one sale of share of the same class, each sale is dealt with in a chronological order. So now example 1. You have sold on 2 Jan 2024 4,000. Remember, this will be first matched against this because you have purchased on the same date 1,000. That's what is written here. So out of this 4,000, 1,000 shares you will take from 2nd June. Then you have to see in the previous 9 days. In the previous 9 days is this 24 December. So 500. So 500 goes. So from 4,000, 1,500 goes. The remaining will be against the index pool. This is how the shares will be matched. Now, index pool. So all your share purchase will be aggregated in that index pool as described below. Step 1. Set up the pool with the cost of the first acquisition. Before adding your acquisition, subsequent acquisition or deducting a disposal, the pool, the total cost is indexed to the month of addition or disposal to establish the current indexed pool cost. The indexed pool cost is recorded separately from the cost. Your cost and index cost are kept separate in separate column. Step 3. When you are selling the shares, the cost and the index cost will be deducted from the pool according to the proportion sold. Example. This you need to remember. Number of the shares disposed over your total shares in the pool multiplied by the pool cost into the and index pool cost. Now, operation of the indexed pool. So the gain and loss is calculated by deducting the cost and the attributable indexation allowance from the sale proceed. Operations are shown in the pro forma in the next section, and indexation applies only to corporate taxpayers and it is frozen at December 2017. So example 2. Let us go through example 2. So as you can see, B is holding shares. There were two purchases done. One is 5,000, cost 7,000. The other one is 900, cost 1,200. Indexation factor has been given 0.269. This is for February 2010. In this case, if you see the date, you don't need the indexation factor because it is frozen to December 2017. Then B is selling 2,000 shares on 2nd October 2024 for 900. So you need the pool because you don't have anything to match on the same date, no previous 9 days. So from the index pool. So this is share, this is cost, this is index cost. 3 column like this you need for companies. Write the date on a chronological order. 1st Feb, because it's on a FIFO basis. So 1st Feb, you have purchased 5,000, cost is 7,000. Okay. Remember to add in the index cost. What is this thing? 0.269 indexation allowance. This you will multiply with the cost, and hence this. So this you will add with the cost, and this becomes your index cost. Of course, your index cost will be more than 7,000. Now, 2nd July, 900, 1,200. Now, no indexation will apply to 2022. It remains 1,200 only. Cost and index cost will be same, 1,200. Then you will add. Now, deduct when you are selling 2,000. So, number of shares 5,900. From here, you will deduct 2,000. You will be left with 3,900. Then, you need to do working to find this one, A, to find B. And it is this B that you need. So A, if you want to find out, just find the proportion. That is, you have sold 2,000 out of 5,900 total share into the cost 8,200. You have got 2,780. Same 2,000 out of 5,900. What is the cost? It is this index cost to get 3,418, and here 2,780. Understand? It's very easy. Now the pro forma. So this is share sold from number first same day matching. Okay, so proceed, you see the cost. Remember, both your share number will reduce and from the cost also. So gain. So it will be included here in the gain column because you need the total gain. Then any unmatched you will see with the previous 9 days. Again, proceed, cost, gain and loss. Again, that gain will be taken here. It could be loss also. Then the third one, held in index pool. Proceed, pool cost, and indexation allowance is B minus A. So gain and loss, this 3 you add and you will get your gain. Sometimes it is just this pool. And of course here you will not have any unmatched shares because whatever you have purchased you have sold. Everything is gone. So the total gain, this is what you need at the end. Now this is the working for the indexed pool. So you need number and cost is there, index cost. So cost of first acquisition will be taken. Then indexation of pool allowance will be added in the index cost column, and add the cost of next acquisition, indexation of pool cost. Then deduct from the pool cost or index pool cost the shares sold. This will be A. This is B. Now, pool cost carried forward. Remember, that indexation allowance is not allowed to create or increase a loss. This is why pool cost A and attributable indexation allowance B minus A must be separately deducted in calculating the gain on the disposal of shares. Moving on to example 3. What happened in example 3? So example 3, we will be solving it. Here they have made two disposal. One on 10 September selling 3000, the other one 1st Jan selling 5000. They have given the shares 6 per share, 7 a share. And company had made these purchases. Share number, cost is given, indexation factor is given. So now let us calculate. So now we need the pro forma to calculate the gain and loss. There are two sales that took place. One in September 2023, the other one is 1st Jan 2024. You have to deal separately and you have to follow the order. 10 September, this disposal we have to solve first. Okay, so now this is September 2023 sale. Okay, here you need the shares, that is the number of shares, cost, and gain or loss. So first we will look whether we have anything on the same date or not. When did this took place? September. So we have 10 September. Purchase 200 and 124 is the cost. Okay, and we are selling 3000. So how many shares are we selling? 3000. And what is the cost? 1 to 40. Okay, so for 3000. Okay, now we are 200 shares we have bought that day, and the cost is 1 to 40. Now what is the proceed? Remember, you need a proceed here. Okay, this is the cost, 10 September. This is the proceed. So the proceed was 6 per share. So it is 6 per share means how many shares? 200 you are selling, right? So since 200 you are selling, here it would be 200 into 6. 200 shares you are selling at 6. Okay, now here you can see it's a loss. Why? Because your proceed is less than your cost. 40 loss. And you are left with, okay, no sum function, 3000 minus 200. You are left with 2800 shares now. Okay, so what is your loss? It's 40 minus 40. This is the same day. You have matched it with the same day. Now moving on to the next. Previous 9 days, did you buy anything for 10 September? No, you haven't. Then you need from the pool. Okay, shares from the pool. Shares held from the index pool. So that's the second. First you have matched with the same date. Now you don't have anything in the previous 90s. Now you will go from the pool. So the balance 2800 you will be selling it from the pool. So what is the proceed? This is one. This is the second one. Same. Okay. From the indexed pool. Okay. Now you need the proceed. So what is the proceed? You are selling 2800 shares this time and at 6. So that would be your proceed. 16,800. Now comes the cost. So you'll be selling 2800, isn't it? What is the cost here? There is a working attached to this to find that. This working will be shown separately from this table. Okay. Now, so this working of indexed pool, I'll write it here. So here it is working indexed pool. Now, shares, this is the number of shares, this is the cost, this is the indexed cost. Okay. Now, so first purchase is 1st October 2007. Okay. Here, how many shares are you buying? You need this table. 10,000 and 10,500 is the cost. Okay. With this, you have to add the indexation allowance here. To this, you will apply 0.331. Drop down the decimal. Now, use the sum function and add this to, again drop down the decimal, so it's 13,976. Now, you are selling 10 September you are selling. September 2023 sold. So here, how many shares you are selling? 2,800 minus 2,800. Now, you need to find the cost, isn't it? So how do you do that here? So this is okay. So you are selling 2,800 out of 10,000 shares. Multiply this with the cost. 2,940. This is the cost. Okay. 2,940. And another thing, you need the indexation as well. This has to be minus here. So here when you're working on the index cost, it is you're selling this much out of 10,000 multiplied by this cost 13,976. So it's 3913. Okay, now you have both the figure 2940 and 3913. So when you come here back to the main table, first we deduct the cost as it is, that is 2940, this one minus 2940. So we will be doing the sum function 13,860. Now we will deduct the indexation allowance. Okay, so the indexation working is like this. It is your this 3913 minus 2940. 3913 minus 2940. 973. So this needs to be deducted. 973. Just put a minus outside the bracket. Now you're going to get a gain. Okay. So do a sum function. Not the whole thing. It's from here to here. 1287. Okay. This is your gain. So when I'm copy pasting it here, I will just take the value 1287. This time it's a gain. And now what's next? The total gain. So the total gain for September 2023 sale is simply take the loss and add this gain 12,847. Now moving on to Jan 2024 sale. Okay, so when we are moving on, what I'm going to do is I'm just going to copy paste this table. Click here, paste. Now I'm going to just change the year and the month. So first I will see whether I have bought anything in Jan 2024 or not. No. So previous 9 days, yes, 23rd December 2023. So in the previous 9 days I have 500 number of shares, cost 3,400. So here, not same day, previous 9 days on FIFO basis. Now I'll match with the previous 9 days. Okay. So how many shares are you selling this time? 5,000. 5,000. So here it's 500 and it is 7. So you are going to sell 500 from the pool at 7. The sale proceed is 3,500. Now the cost. They have given the cost already in the table 3,400. Okay. So when you deduct it, it's 100. 100 gain. So now you are left with 4,500 shares. This 4,500 shares you are going to use the index pool, share from the pool. So now the proceed. Once again, how many shares? 4,500 shares. Click this into the price is 7. This many shares you're going to sell. 31,500. Then this is 4,500. But to get this indexation allowance and this too, you need a working. So we'll go back to our working here. In the same table you're going to continue, no separate working. Okay. Now you see you're going to do a sum function. How many shares you have in the pool? 7,200. Okay. And here I'm going to deduct the cost 7,560. And then here the difference came due to rounding figure because these things were rounded. Okay, so that's fine. Now how many shares you have? You're going to sell 5,000 shares. But out of 5,000, 500 you have matched with the previous 9 days. Now remaining 4,500 you are going to sell from here. First Jan 2024 you are going to sell the remaining 4,500 from the pool. Okay, so here the cost would be okay here. So you're going to sell 4,500 out of 7,200 into 7,560, the cost, which is 4,725. So this is the cost. Now the indexed cost. You're going to sell 4,500 out of 7,200 into this cost. Okay, so I'm going to drop down the decimal. 6289. Okay. So now I'm going to go back here. 6289. So here if you see the pool cost, 4,725. I'm going to deduct 4,725 from here. And then the indexation allowance is simply 6289. Your index cost, unindexed, index cost minus unindexed cost is the indexation allowance. So 6289 minus 4,725. 1,564. And your gain is 25,211. With 100 if you add, this is your total gain, 25,311. So your total gain for year ended 30th June 2024 would be this. It is this gain plus your this gain, 38,158. I know there are a lot of working, but if you follow the step one by one, it is very easy. You just have to keep on following the step. So this is the answer for example 3, where we have divided the September 2023 cell and Jan 2024 cell. First we'll deal with the first one, where we have matched it with the shares acquired on the same day and shares held in the index pool. So we got 40 loss first, and then again we add them together. This is the total gain. Keep it. Then we went to Jan 2024. We have shares acquired in the previous 9 days we matched and shares in the indexed pool. The same way. Now finally we add the two sales of two different time. Now this is the working for your indexed pool. Now moving on to fifth part, which is bonus and right issue. First, bonus issue. Bonus issue will increase your number of shares but not your cost, because you are giving new shares at nil cost. Bonus means you are giving new shares, you are issuing new shares to the existing shareholders but at nil cost. What is scrip issues? Scrip issues are new shares issued instead of a cash dividend. So with individuals, what happened? It increases the number of shares but not the cost. Same for the company. Right issue. Right issue is you're giving new shares at a discount. This will increase both your cost as well as the number of shares. So here we are going to have an indexed pool cost for right issue. Now, activity 3, we have both bonus and right issue in the same question. So you need to calculate chargeable gain when you are selling the shares. So here I've acquired 10,000 shares. A quoted company for 25. You have acquired 10,000 shares for 25,000. Okay. On 6th June, I received 1:5 bonus issue, and on 24th, 2013, 1:10 right issue for 4 per share. On 30th June, sold 12,500. Net profit is this much. Indexation factor for different time period has been given. Now let us do activity 3. So to calculate the chargeable gain, we need proceed, the cost, and the indexation allowance. 3 things. Okay. So we'll do it here. Proceed, the cost, pool cost. There's a working to this, and indexation allowance. And your gain, chargeable gain. So proceed have been given to you already, 87,500. Right? It's given in the question itself. What is the proceed? 87,500. Cost you have to do, and with cost only you will get indexation allowance. So we will use the same table here that we did for the previous activity. Share cost and index cost, 3 columns you need. Now 17 October 2003. We have purchase done. Okay, so what is it? 10,000 and 25,000 is the cost. 10,000 and 25,000 is the cost. What about index cost? Remember, there would be no index cost. Why? Why is it? See, look at the dates. Okay, October 2003 to June 2008. Okay, look at the day. It's not one period. They have given it for months. So 17 October 2003. Both are October 2003, the first two. But one is till June 2008, the other one is till August 2013. See to it. Are you having any other event? Yes. From October, you have purchased, you have received a bonus. Bonus is on 6th June 2008. So you have to take that also into consideration. And also, you have to take the right issue which happened 24th August 2013. So you have to add the bonus and the right, and then only you can index. But is it like that? No, you have to index twice. One from October to June 2008. The other one is from October 2003 to August 2013. So once you have to index, that is after bonus. The other time you have to index is after you add right issue. Another time you have to index. It is called a re-index. Understanding? So now you will add the bonus. 10,000 and is 1:5. Bonus issue is 1:5. So if you see here 25,000, your index cost also would be 25,000. Now you will be adding 6 June 2008 bonus issue. One is to 5. One is for 5. So just divide by 5. 2000 at no cost, so it's not going to affect your index cost. Okay. So here your index cost shares are this now. Now before you take the right issue, you have to index. Okay. So it is here. Index October to August. First you index and then you do the right issue. So only index cost column will get affected. Here. How do you do that? It is simply 25,000 multiplied by, look at the date, 0.320. 0.320. Done. 8,000. So 8,000 is index cost. Then we will be adding the 24th August. August 2013. Right issue. 1:10. 1:10 into 4. So now here you have 12,000. This many number of shares divide by 10. 1,200. Then the cost would be this into this plus the undo button, this into 4. 4,800. So here also is 4,800. Now you need to add the total, the sum column. Now you have to index again before selling from August to December. This time when you are indexing, from August to December. So here it is 0.108. On this, multiply by 0.108. So with this, we'll be adding this 41,882. Now comes the sale when we are selling. So we are selling, see how much you are selling. 12,500. So from 13,200 shares, we are selling 12,500. Okay. This is pool carried forward balance. Here. Minus 12,500. So you have 700 number of shares worth still in the pool. Now comes the cost. So 12,500 shares you are selling out of 13,200 multiplied with the 29,800, which is the cost. So we are going to drop down the decimal. 28,220. And here index cost 12,500 out of 13,200 multiplied with this 39,661. So now this is the cost 28,220 that we are going to deduct from here. Okay. Okay, so this is the process. This is the pool cost now. Minus 28,220 and get the balance. Now to get the indexation allowance, it is simply 39. The difference 39,661 minus 28,220. So this is your indexation allowance which you need to deduct. No. Now the sum function. So your gain is 47,839. So this is the answer for activity 3. It's a long working that is required, but finally we have got the gain. Remember one thing, working always needs to be shown second. Your main thing has to be shown first to the examiner. This is the pattern of writing your exam. Okay, always main thing. So first proceed, you deduct cost, then indexation allowance. You need this. This is your cost here, and this is the same cost you have got here. Okay, so you need that correct to get your indexation allowance correct. Then only you will get your chargeable gain correct. Now moving on to the reorganization of share capital. The rules for individuals are same, except you have to take indexation. That is the only difference. So with that understanding, we are going to go through activity 4, where J is owning 2,000 of company B shares that you have acquired in July 2007 for 5,000. 2,000 shares for 5,000. Company A takes over B and offers 1 ordinary 2 preference share is in A for every ordinary share held in B plus 60 plus cash of 160 pence per share. Market value of A shares. Ordinary and preference has been given 2 per share, 1.2. Then J is selling all his A's ordinary share for 3 a share. Now the factor has been given, indexation factor. You need to calculate the chargeable gain arising at the date of exchange in May 2004 and on the sale of company's A ordinary shares in Jan 2025. Twice. When you are exchanging shares in May 2024, that is the day you are taking over. And finally, when you are selling all of the company's A shares in Jan 2025, you need to calculate the chargeable gain. So let us do this. So first we'll deal with May 2024. Okay. Now, what is it that you are receiving? See, from your understanding, this is why you need the understanding of reconstruction from your income tax when we were doing income tax, the CGT on shares. There was a lecture when I was doing CGT on shares. You need to watch that lecture very well. There, everything has been explained. So with that understanding, we are moving forward. I'm not going to repeat it here in this lecture. Now, it is said there that when you are making any share exchange, there is no capital gain tax, but there will be capital gain tax when you are receiving cash. So on that, so the proceed that you are receiving in a form of cash, only on that there will be a chargeable gain. So how much cash you are receiving? You have acquired 2000 shares. Okay, so it is 160 pence per share. 160 pence per share. Here we are going to do it. Okay, 2024. Okay, so May 2024, your proceed is the cash received. 2000 into 160 pence is 1.6, so 3200 is your proceed. You need to deduct cost for which you require working. Okay, you can always do a formula like this, keep it. So the moment you put the number here, automatically you will get. Now indexation. So you need to deduct the indexation allowance as well. Once you do it, you will get your chargeable gain. Just do the sum function. Done. Now, when you're receiving a cash, okay, it's a part disposal. Why is it part disposal? Because you are going to sell it later on, not now. That's why. The cash that you are receiving, you will treat it as a part disposal. Now moving on to the next. Second. Just I'm going to copy paste here. Except the dates. Now when we are selling the shares. Jan 2025 when you are selling the ordinary shares. So what is the price? Proceed. You are going to sell A ordinary share for 3 a share. So all 2000 shares that you have bought, you are going to sell now. So here it would be 2000 into 3. That's it. Now we are going to do the working to find the cost and the indexation allowance. Okay. So that working we can use this table that is already there, the share, the cost and the index cost. So now, how many shares you have? This is very simple. July 2007. So you have 2000 shares. The cost is 5,000. Index cost also will be 5,000. Now you need to add the indexation allowance. How much? They have given you this into 0.349 from July to December. 0.349. So it is 6745. Done. So now remember, this is not enough. This is for the full. You need the proportion. You have to apportion your cost of B's ordinary share to the new shares and cash. That apportionment you have to do. That how are you going to do? Purchase consideration. PC. Cost. Indexation. So you need to draw a column like this. Okay, this is consideration, your purchase consideration. So ordinary share is 1:1. Next, preference share. See, in case you forgot, you can always refer back, okay? Preference share is 2. Okay, it is 2:1. And then cash, 160 pence. So this is easy. We have already got it. 2000 into 1.6. This is 2000. And this would be, sorry, ordinary share price has been given to 2. And preference share is 2000 is 2:1, right? So into 2 into 1.2. The price 4,800 is your preference share. So your total purchase consideration, if you add, is 12,000. Does it end? Now the cost. So when you're finding out the cost, it is this over 12,000 multiplied by, what is the cost? They have given you the cost. Remember, 2000 share worth 5,000. So that 5,000 cost. You have to drop down the decimal. So this 5, okay, so now I'm going to fix this 12,000. So I'm going to lock with a dollar sign and drag down. What happened? Here also is the same thing, 4,800 with the proportion of 12 into 5. That 5,000 and 12,000 remain fixed, except only this keeps changing. Now, you see the total is 5,000, it is a portion like this. Now the indexation is the same. This is the consideration out of 12,000 into what is the index cost? You have to use the table that we have just used. It is 1745. This table is the indexation allowance. not indexed cost, indexation allowance. Because indexation cost obviously it will be more than the cost, no? 582. So this, what I have to do? I have to lock this row. So before 50, I'm going to put $sign, and 12,000 after K before 57, I'm going to put $sign because I want to lock 12,000, the row of that. So the row remains at 57. Now I'm going to drag this down. Okay, just copy paste it. You see it's 1745. So now I know the portion meant. Okay, so now what's there? I know the cost now, right? This is the cost. Look at the cash and this is the cost. This I have to deduct. Okay, I need this. I need from here. You see now? Minus 133. Done. And then the indexation. 465. Minus 465. So 1402. This is the gain. Now, when we are selling here, coming to Jan 2025. See, we are disposing shares, okay? We want the cost and the indexation allowance for the share part. What's happening? It is this ordinary share we are selling. This and this, 582 and 1667, that you need to deduct from here. So we need to deduct 1667, and we are going to deduct from here 582, and this is the gain 3751, because we are selling all of the ordinary share. I hope you have understood. Now what is there? J still holds company's A's preference share because he is selling all of the ordinary share. So this is the answer for activity 4. Here we have got the chargeable gain for May 2024 relating to cash, and here when we are selling the shares entirely. So we have used the cost of ordinary share and the indexation allowance of ordinary share. Here we have taken the cash. Okay, so these are the workings to find the number cost and the index cost from the pool. And this is we are apportioning the purchased consideration 12,000 and the cost 5,000 among the three, ordinary, preference and cash. And then we have worked out this is the working for the indexation. Now the last part of this lecture, that is the rolled over relief for companies. Companies are only eligible for one relief, that is rolled over. So the conditions for relief, it needs to be a replacement of business assets where you are going to defer the gain by selling the subsequent replacement asset. So this deferring of gain is there for both personal and corporate taxpayers. For individual, qualifying business asset, if it is sold at a gain, taxpayer can roll over the entire gain if you have reinvested all of the proceed in another qualifying asset. Goodwill is not a qualifying business asset for a company. This is a difference with individual taxpayer. Now the conditions for relief. The conditions that apply for individuals apply to companies as well. Please go back and watch my lecture 15. So they are under my tax playlist. Then both old and new asset has to be qualifying business asset. Qualifying business asset includes land, buildings, fixed plant and machinery that do not form part of a building. Movable plant and machinery such as your vehicles are excluded. Okay, your vehicle is not a qualifying business asset. Old and new assets should not be in the same category. They can be in different category, but it has to be used in the trade of the taxpayer. Tax the taxpayer have to reinvest between 12 months before and 3 years after the date of disposal of old asset. This all are same. Now, how does the relief operate? One difference is indexation relief is here for the company. As with individual, no tax is gained on the gain on the old asset, and indexed gain is rolled over by either deducting it from the cost of new asset, or if the new asset is a depreciating asset, you defer the assessment of the rolled over gain for a limited period. You calculate the gain and keep it. It will become taxable in the earliest of the 3 events. Those 3 events I've described in lecture 15. So for full relief, you have to full proceed have to be reinvested. If only part of the proceeds are reinvested, then you are going to get partial relief. That means some amount will be chargeable to gain. Amount that is not reinvested will be a chargeable gain. Now this is the pro forma. So when you are selling the original asset, net sell proceed less cost, deduct indexation allowance, get your rollover relief. In fact, your rollover relief in this case, if you are not fully reinvesting, it is the balancing figure. Why? Because the chargeable gain is equal to the amount not reinvested. That easily you can get. And your chargeable gain will be zero if all the proceeds you have reinvested. Now, then the subsequent sale of replacement asset. Net sale proceed, deduct the cost. From the cost, now the rollover gain that you have calculated when you are disposing the original asset, deduct from here. And indexation allowance. This time you are going to get a higher chargeable gain because your cost is more. In fact, your cost is reduced. So if you are going to have a lower amount that is deducted from a sell proceed, your gain will be higher. Let us do activity 5, rolled over relief. So you have to calculate chargeable gain ended 31st December 2017 and 24 after claiming rolled over relief. Okay, so this is about they are selling an office block used in trade for 1.25 million. Cost was 700. And on 1st July, they have bought a replacement for 1.4 and sold it for 1.5 without replacing. Indexation factor has been given. So here when we are selling the original factory. So here September 2017 sale of original factory. The proceed. So the proceed is 1,250,000 and the cost is 700,000 minus 700,000. Now we are going to take the indexation allowance. So the indexation allowance is you have to use from October to September. October 2007 to September 2017, 0.343. Okay, so 0.343 you have to use on this 700,000. So now rollover relief. Okay, and chargeable gain. See, you have sold it for 1.25. and you have bought another replacement for 1.4. That means you have used the entire amount that you have got from selling the original factory in buying new replacement factory for 1.4. That means it's a full reinvestment. The entire amount is rolled over. So in this case, this I'm going to copy, paste the value. This is the rollover relief, and hence your chargeable gain is nil. Now in October 2024, when you're selling the replacement factory, so the proceed, okay, is 1.5 million. Then the cost that you're taking, it is July 2017, so you bought it for 1.4 million. Now the rollover relief you will deduct from here. Okay. So this is the amount you have to deduct from the sale proceed. Okay, this is the cost you are having. Now the indexation allowance. Which will run from July to December, 0.019. So here equal to, it will apply on this 0.019. Drop down the decimal, keep the number as whole, and it's this minus this. So 389, 100, 188 is your chargeable gain. Now what happened? See here, this gain will be chargeable now, and this one no gain, okay, because you have reinvested. So the solution for activity 5, this is so entire amount is rolled over because we have reinvested the entire amount. The cost of new factory was 1.4. The proceed we have received from selling the old factory was 1.25. Therefore the gain is 0. And here for replacement factory this becomes chargeable. This rolled over relief we deduct from the cost of the new asset. Now claim. So the claim must be made within 4 years of the end of the accounting period. For individual, it is end of the 4 years within the end of the tax year. That is the only difference, but it's 4 years. So for 2024, it will be by 31st December 2028. Or within 4 years of the end of the accounting period, in which a new asset is acquired, whichever is later. Selling of old asset or buying of new asset. Then depreciating asset. The relief for reinvesting. In depreciating asset works the same as for individual. See lecture 15. So in this lecture, we have covered the third part under corporation tax, that is chargeable gain. We have calculated the chargeable gain for companies, explained the indexation allowance, where the factor will be given to you, the treatment of capital losses, even though the detail will be explained in lecture 19. Then disposing shares by matching with the same date as you have acquired, previous 9 days on a FIFO basis, and the index share pool. So bonus issue, right issue, takeovers and reorganizations we have covered here, and the rollover relief. So let us summarize For corporate tax holder, it is same class, same company, are matched with the accusations in the order. Same day, previous 9154, indexable. For companies, for individuals, this is different. It is in the next 30 days on a FIFO, and this is not indexable, it is just a pool. Now, the indexed pool cost is the total cost indexed to the month of the addition or disposal. They are recorded separately. Remember, cost and index cost are recorded in separate columns. We have done it, right? Then gain and loss will be proceed less your cost less your indexation allowance. And your indexation allowance cannot create a loss. Indexation is frozen at December 2017. Now, bonus issue will increase your number of shares but not the cost. So it has nothing to do with the index cost. But right issue will increase both the cost, your index cost, and the number of shares. So right cost, when you're indexing, they have to be separately indexed from the month of accusation. Then when you're receiving shares in share for share exchange, okay, it is treated as the same way for the individuals. The corporate will be treated as the same like individuals, except you have to take indexation into account. That is the only difference. And rolled over relief works in the same way as for the individual, except here we have indexation to be deducted. And if it's a depreciating asset, it's the same. So in this, we have a technical article to read, that is chargeable gain part 2. Please, on your ACCA website, do go and watch it and read it, so you will have a better understanding of these lectures. Thank you for watching, and I shall see you in the next lecture, that is lecture 19. Lecture 19 will be focusing on the loss reliefs, all the type of loss reliefs for companies, whether it's trading loss, capital loss, property business loss, other losses, and the relief for it. A very, very, very important lecture. Thank you and take care.